What if I told you that already today we can see signs that SoFi will miss on the next earnings for the first quarter of 2025? It doesn't necessarily mean that the stock price will go down, because as weird as it might seem, the decisions that are made in Trump administration actually provide some positive catalysts for this company that we haven't seen before. So the main message of this video is this: I'm very bullish on SoFi, but be aware of what's coming in the next couple of months. I will discuss every single point so you can decide for yourself what to do with the stock of this company. Hey there and welcome to the Market Monkeys channel. It's Julie here, and today I won't bore you with the numbers from SoFi's latest presentation. First of all, because we have talked about these numbers already a couple of times on this channel. Second of all, if you are an investor of SoFi or if you are following the news of this company, I am sure you know all of these numbers by heart. So SoFi is a digital finance company that actually aims to be this one-stop solution for all of your finance. They offer different financial services, including student loans, credit cards, and investment services. But here is the main shift. SoFi is trying not to be this lending company. In the past, lending revenues were 90% of the total revenues of this company, and right now they're down to 54%, and I'm pretty sure that this quarter we will see it even lower. And this is actually very smart because lending is the riskiest segment of its business. The main positive and negative catalysts for SoFi in the short term as well as in the long term come from Trump's administration. I can say that most of the changes that he is making will impact the business and the stock price of this company. For example, I am pretty sure you have heard that there are talks about the education department being shut down. If it will happen, the Treasury Department or the Small Business Administration will need to take a part of the responsibilities of educational departments on itself. This transition will likely affect negatively student loans. It will make them more expensive, stricter, and also less flexible. Besides of the student loans, I saw an information that some part of government budget for student grants and scholarships will be cancelled as well, and as a result the demand for student loans will rise significantly. Needless to say that I hope for the future of the US that this shutdown won't happen and that the Congress won't vote for this, but if it will happen, SoFi will be one of the companies that will benefit the most. The company is perfectly positioned to profit from these changes because originally SoFi was created as a company by students for the students to refinance the student loans. Another point is that its student loan originations reached $3.78 billion in 2024, marking a 44% year-over-year increase, which basically supports my reasoning of SoFi being perfectly positioned to earn from these changes. If you find this information valuable or useful, don't forget to support this channel by pressing a like button and subscribing and writing a comment. But the current economic conditions bring not only the long-term potential for SoFi, but also short-term negative impacts that we must take into account. First of all, the tariffs will most likely boost the inflation. Even if it will not happen today, anyone who studied economy will tell you that this is inevitable. Second of all, recession fear. I'm not sure if you've heard, but right now everyone is talking about this. The recession is a possibility, and as a result of all of these uncertainties, the consumer sentiment index has dropped below 55, and this is the lowest level in 3 years. And it basically means that in the past 3 years, consumers weren't this pessimistic about the future. And when the consumer is pessimistic, he stops spending the money. So basically it means that people won't plan right now some big purchases like cars, for example, or houses, and as a result they won't take the loans. At the same time, VIX or volatility index is 43% up, which is not surprising because in other words it's called the fear index. So this basically supports the point that people are afraid and people won't be spending money as much as they did before. So the bad news is that upcoming earnings results might affect all of these uncertainties, but the good news, the management seems to be learning from the past mistakes. I remind you that in 2022, the revenue from lending was more than 90% of its business, and if the same situation would be right now, I would tell you to run away and to close this position right now. Lending is majorly dependent on economic conditions, so the moment people would stop taking loans, or even worse, if they wouldn't be able to repay the loans that they already took, the company would be screwed. Now, even if the lending segment of SoFi's business will take a hit, it will be definitely painful, but it won't kill the company because the company has some strong revenues from other segments, for example, from tech platforms or financial services. Besides, we have some other positive news. The management is making some very smart decisions, like for example, instead of lending the money by themselves, they're actually originating loans for third parties. And this is amazing. Basically, what company does is finding people who want to take a loan and connecting them. They're like a middleman to the institutions that are ready to give those loans, and vice versa. They have an institution that is ready to give the loan and they're looking for clients for that loans. This is amazing because first of all, SoFi is getting nice fees for the services, and second of all, it takes zero risk on itself. It doesn't have these loans on its books, and all of the economical uncertainties and all of the negative impacts that might hit the company lie on the other institutions. The company had some very impressive deals in the past regarding this part of their business, but recently we've got the news that they just signed the biggest deal that they've ever had for the loan originations for third parties, worth $5 billion with Blue Owl Capital funds. And finally, the company begins to behave more like a platform and less as a bank. And if you have watched my previous videos, you know that one of the points for me why I was the most skeptical is because SoFi was positioning itself as a fintech company, while more than 99% of its revenues were coming either from lending or from financial services. So basically the tech part was insanely small. The tech segment is still the slowest growing segment for SoFi. It's growing 10 to 15% year over year, but I like the direction in which SoFi is progressing. Management's guidance for 2025 projects a revenue growth range of 23 to 26%, and it's slightly lower than 2024's growth rate of 26%. This fact alone raised some questions regarding the ability of the company to scale. But I have another question. Do you think that 1.5 months or 2 months ago, the management of the company could predict these economic difficulties or even this economic crisis that we're going through right now? And the answer is definitely no. From its earnings presentation, we can see that while the guidance for growth is below 2024 levels, the assumptions that the management used to make this guidance were completely wrong. For example, they assumed interest rate outlook consistent with the forward curve and just north of 1.5 rate cuts. First quarter starts on January 1st and ends on March 31st. And while there is still a chance that Fed will cut the rates this year, we can definitely say that it won't happen this quarter, so this assumption was wrong. And this assumption was used to create the guidance for the first quarter, so what can we say? If the assumption was wrong, it means that the company should do much better than management expected in order to actually deliver the same results. And can company do better? Probably the company itself, yes, but can it do better under this situation? I'm not so convinced. By the way, analysts are concerned as well. If we will take a look at the revisions for the past 90 days, we will see that there was one up with 6 down. It means that the analysts are less optimistic for the future earnings, and so am I. Can companies surprise us? Definitely can, but right now it looks like the earnings will be missed. By the way, another important point to take into account, regardless of the fact that SoFi stock dropped more than 20% in the past months, the valuation stays premium. For example, its price to sales ratio almost twice higher than the sector median and 6 times higher than the sector median in price to earnings. Wall Street analysts have price targets from $5 per share on the low end, which seems very pessimistic for me. I mean, if the stock of this company drops to $5 per share, it will mean that the company is very undervalued and it's selling with a huge discount, and I will definitely buy. The analysts give $14 per share price target prediction on average, and it seems pretty reasonable to me, although I must say that with the current situation, if it doesn't improve until the earnings, I am not convinced that the price will reach $14 per share. I think it will stay below this point. If the situation will start improving, it might take a quarter or so for the stock price to catch up with the bullish sentiment. $20 per share on top feels also reasonable, but only if the company will surprise us on earnings, and not only once but maybe a couple of times. So for me, the stock price in the range of between $14 to $20 per share seems fair, but in the second half of 2025 and not right now, if the situation will be plausible, if the situation will be stable. So for the conclusion, I really like the direction in which SoFi is moving. The management seems to recognize the weaknesses of this company and to work on them, but I rate the stock of this company as a hold until the next earnings results, and I have 3 reasons for this. First of all, the guidance was lower than everyone expected, and the assumptions that were used to build this guidance were wrong. So in my opinion, the chances of the company to beat the earnings results are very slim. Second, although I believe that these macroeconomic factors won't affect the business of the company in the long run, it definitely has negative impacts in the short run. So with the fear of the recession and with everything that is going on, I am pretty sure that the business will suffer. Third, buying SoFi stock before the earnings results in this current market situation increases significantly the non-systematic risk in my portfolio. And the non-systematic risk is the risk that we are not getting paid for. And the financial industry will be the one that will be hit the most by these economic difficulties. And believe me when I say you don't want to be invested in SoFi if the recession hits. Also, the earnings are months and a half away, but the quarter ends like 10 days from now, so we're working here with an outdated information. I want to wait for the results and buy this to lower the uncertainty risk as well. And by the way, if by the time of the earnings, after the earnings, the stock price will go up, I will be completely fine to pay more money for less risk and for more certainty. I would very much love to hear from you. Did you find something new? Did you hear something new for yourself in this video? If so, please write a comment, like this video, subscribe to our channel. I will see you next time. Happy investing!